Welcome to RealAg Live, everybody. Thank you very much for joining us here today, whether you're watching on YouTube, Facebook, Twitter. What do we got? YouTube, Facebook, Twitter, Twitch is another one. Yeah, so we got lots of ways to view this program. Thank you very much, everybody, for tuning in today. Greatly appreciated. We got a great discussion today on economics. We're going to be joined by Gervais of Farm Credit Canada. If you want to participate in today's discussion, all you have to do is leave your question or comment in the comment box, no matter which platform you are watching on, Twitter, YouTube, or Facebook, or Twitch. So we'd love to have some participation. Yesterday we had a great time with Shane Thomas talking about technology. And of course, you can go back to realagriculture.com/live to view any of the archive of these programs. We also podcast them as well on the Real Agriculture Podcast Network. So lots of ways to participate in this kind of content. And of course, you can hear Real Ag Radio every day at 4:30 Eastern on Rural Radio 147. Today's guest is JP Gervais, Chief Economist with Farm Credit Canada. I'm going to bring him in. JP, how are you?
Oh, I'm doing super well. What about yourself?
I'm doing good. And honestly, JP, I'll be honest, I was 2 months ago, I was kind of a bear on the Canadian economy. The Canadian economy is looking not too bad right now.
Well, I don't think you were, I think I was actually I guess I could say that I was in your company. I have to be truthful here and full disclosure. I've been very negative at the outset. I just did not know that we were going to rebound the way that we have in May, as well as likely to be rebounding as well in June. I mean, I know it's in the past, but we're going to get the date on Friday. Huge, very significant data release about
Yeah.
GDP on Friday coming up. So I would say that I was as well not too optimistic, and it turns out that we rebounded really well.
So we're going to have the June GDP numbers also for Q2. JP, right away, I'm going to get ahead of the audience, and I'm going to say how much of this stability or recovery to the Canadian economy, and quite frankly, the U.S. economy, has really been led by the fact there's been such high amounts of government support and money flowing to kind of keep things afloat.
No doubt. I mean that it's been support has been very critical in the rebound that we've seen in May, and that we're likely to see as well in June and July as well, because Friday we're going to get an early estimate for July, which is going to show as well some growth. So no doubt. I mean, it's there was, and I think it's somewhat explainable into some. Somebody brought up the idea that, to me, the fact that average wages in the Canadian economy actually went up during April or part of March, April, and May. And the question was, well, did we see Canadian businesses offer more to workers? And the answer is actually no. It's just the fact that those that lost their jobs were at the bottom of the pay scale. And so by
Oh,
simple math, right, you get rid of the lower wages, so it brings the average up. And so this is why it was so critical to offer some level of support. And the fact that we extended that level of support as well going into the next 4 weeks, as well as, reviewed some of the criteria for unemployment insurance and so forth. I mean, that sort of establish a pretty good floor in terms of household spending. Um, Credit card purchases or credit card data in terms of consumer purchases as well is one of the data points that we get in real time as well that financial institutions have been willing to release, and are showing as well that, hey, consumer spending is up. What we have to be thinking about are business investment and trade really are the two things that I believe would really dictate at the end of the year if we're back to where we were beginning of 2020, or are we under, are we a little over? That's, I think, the key question going forward.
yeah, and Canadians have, you mentioned consumer spending, whether it's hot tubs, mountain bikes, RV trailers, they've definitely spent some money. Now, what has happened with the savings rate? Do you have that off the top of your head? Because Canadians were kind of we weren't very good on that number prior to COVID. We've kept on spending through this. What does that look like?
I haven't looked at the exact number or the top of my head. I just don't know what
Yeah.
happened to the savings during the pandemic, but I would suspect that it went up as well. I don't know that any type of boost in income has all been captured and absorbed by a boost in spending. So I would suspect that you're likely to see a little bit of higher savings here.
So as we look at that report on Friday, the GDP report, What is it if it does work out to be okay or better than we thought if we go back a month or so ago? What does that tell us? What kind of indication is that for what the Q3 and Q4 could possibly look like?
Yeah, I think the question marks around Q4, not just because of a potential second wave and everything, but if you put that aside just for now, right, and you think of the recovery, I think there was little debate about the fact that once we reached the bottom, we were going to grow again, and then we're going to grow rapidly, right? So that's the V-type recovery, right? So sharp decline, fairly sharp rebound. That's what we've seen in May and June, and likely to also see when we had more data in July. Now, the question to me is, when you come back closer to where you were when pandemic started, when in the early March, or even put the early part of the year, early 2020 as a starting point, right? Where are you at the end of this year in December, right? Are you at where you were at the beginning of the year, or are you under a little bit under below a bit under where you were at? And I do think that that's going to be the case. I just feel that the last couple of percentage points to get us back to where we were are going to be a lot more difficult. That early rebound and that early boost that we've seen in the last couple of months, simply because I mean you have to think about businesses and some of the financial challenges that are continuing to emerge, across sectors. Obviously, the reality is a bit different, but some businesses are going to be struggling towards the fall and early winter, and that's going to make it really hard for us to get those last percentage points of GDP back. And that's when I think it's going to be super interesting to understand the dynamics of the labor market then, policy wise, what is going to be offered and so forth.
It's not all rosy out there. I just saw a headline in the Globe and Mail. Mexico's economy records worst quarter since Great Depression. So the gross domestic product fell 17.1% in seasonally adjusted terms in the April-June period from the prior quarter. Compared with the same quarter last year, GDP contracted 18.7%. Things aren't good in Mexico, JP.
Yeah. Our contraction in April and May was in that 13 to 17% range. We're likely to see something in that 8-9% range when you compare June of 2020 to June of 2019. So we'll likely also have a Q2 that beats all the records in terms of it's going to be abysmal, but at the end of the day, we know that there's a rebound, right? So that's the reason why you have to be really digging into the data and not only look at the Q2 number, but look at the most recent data points as well as the early estimates for July that are suggesting that we're doing better. But again, it's getting back to that level, right? As soon as getting the first few, I mean, you have at the end of the day, let's face it, right? We have 1.3 million Canadians that are unemployed relative to where we were in the early part of in February. So we still have quite a bit of economic pain and stress out there.
That's
sure.
a lot. We have just sub 40 million Canadians in the country, and we got 1.3 million. That's a big number, JP.
It is a big number. I mean, in the U.S., it's 14 million, and you still are unsure. In the U.S., we're still unsure as to how actually they're going to extend benefits, unemployment benefits and some of the support that they've provided, right? So I think they're going to come true. But so there's lots of economic uncertainty still, I would argue, and lots of economic stress as well going on.
Okay, fill me in on the Canadian dollar. We are trading, I believe, just south of 76 cents today. I remember that, not too long ago, we were I think bouncing off of 68 in the beginnings of COVID. We have had quite a recovery back to where we were pre-COVID. It's I probably created a lot of gray hair for a lot of farmers trying to figure out what to do with their currency hedge accounts. Oil, I believe, is around $45, if I remember right from this morning. Is that the driver higher? What's going on here?
Well, I think it's just the weakness in the U.S. dollar, and this is a really big. It's a bit of a question mark for me, right? So, I get it, right? From a Canadian perspective, you're struggling to understand why we're at 76 and what to do with it, right? Because I think most of the signals point out to a weaker Canadian dollar. If you look at any type of the modeling that we have, modeling that has been done by other financial institutions, you're looking at 74 for the rest of the year. And yet, we are at 76, and it doesn't look that loonie is going to get any lower with respect to the U.S. dollar. So I'm willing right now to consider that, hey, we're going to trend sideways. The good news in that case, right? It's always a double-edged sword, right? So on one side, the fact that the U.S. dollar is so weak is good for commodity prices, right? So it brings up it increases the purchasing power of all those countries that are importing commodities, and so demand's really strong. We can talk about China and some of the commitments that they made in terms of purchasing U.S. commodities, and so that's good overall for commodity prices. The other side of the coin, though, for us is that it brings a little bit of a disadvantage in the export markets, as well as when we're converting these prices into Canadian dollars, it puts us at a bit of a disadvantage. So overall, I haven't changed my mind. I do think that we're better off in the weaker dollar, weaker loonie environment. But in this case, it seems at least sort of the silver lining in all of this is that I think it is supportive of prices, at least in the short run. So I think that's a good thing. I think there's also another source of not stress, but I mean, we have to wonder as well what this is going to do to the Canadian trade balance. Our exports decline, imports decline more than our exports decline. So overall, that's been a positive contribution to overall economic activity because what matters is net trade, right? We export more than importing more. But if the dollar our loonie continues to be strong, I think that's going perhaps increase and support imports, and that could also show up in some of the GDP numbers later in the year.
Well, and some volatility to look for in the short term is Hurricane Laura, right in the Gulf of Mexico, concerns about crude inventories, that pushes the crude price higher in the short term, buoys up the Canadian dollar as well. So that's something to watch really, really in the short term here.
Yeah, you have to also, I mean, of course, oil is a big driver. I mean, but it's the entire expectations of the markets with regards to what is going to happen in liquidity. And it looks as if, the markets believe 100% that the stance of the Federal Reserve is going to be quite loose for a long period of time, right? And in Canada, we had our own liquidity injection, which has been pretty aggressive, right? All size, considering the size and the scale of our economy, I think we've been one of the most aggressive. Yet, it looks as if markets believe that the U.S. is in this longer, and I think that's what explains the weakness in the U.S. dollar. Because now I think we've lifted some of the questions around coronavirus and so forth, right? There's still that big cloud hanging over the economy, but I don't know that we're going to be going back to what we experienced in March and April. And so, a bit of a struggle for me to understand why we're so strong. I would expect the US dollar to show up a little bit better, but I do think that, markets believe that, hey, liquidities are going to be present for a long time in the US economy.
I almost feel like doing one of those questionnaires again. Like when we were at like 69 cents, I remember asking yourself and a lot of other analysts, okay, what do we hit first, 65 or 75? And I think pretty much 9 out of 10 that I asked said 65. I almost feel like saying, do we hit 80 or do we hit 70? It's, but it's not a question to go to that, to have an 8 handle, but it just feels like it's not where we should be.
It just feels like the markets are way ahead of themselves, right? And I hate to start to talk about the stock market because I just don't feel that's my expertise. But again, just in the stock market as well. I mean, you feel like markets are way ahead of where the economy and the fundamentals are, and that the underlying risk, downside risk in this case, I think is pretty huge. And so in that case, to me, I would again say that we're more likely to hit 70 than 80, but the way that things are going and the support of the markets behind equities and as well as the fact that they believe that the monetary stance in the U.S. is not going to change and can only be more accommodative and over the long run, I think it may actually push the U.S. dollar lower.
I don't have the number at the top of my head. Lizanne Saunders, from an analyst in the U.S., I talked about her on the radio show a couple days ago where she talked about how just like such a small percentage of the people in the U.S. actually hold such a large bulk of the equities. So, you do have to ask yourself those ups and downs and who they're really benefiting or hurting. But I'll tell you why people are putting their money in the market, JP. I looked at the bottom of this story that was quoting on the Canadian dollar. What does it say here? Canadian government bond prices were lower across the maturity curve. The 2-year yield was 0.304%, up from what doesn't matter, while the Canadian 10-year yield rose to 0.617%. 0.617% on a 10-year. That's not a good place to put your money, JP.
And I remember the last time you and I was speaking, we were talking about interest rates, and I did say that, hey, what we had seen then, I can't recall when exactly what it was. I mean, it's probably everything that we are going to see in terms of borrowing costs, right? But the fact of the matter is that it's a great time for anybody that needs to be borrowing money for investment purposes and so forth, because interest rates since then over the last couple of months have actually can become lower. So the competition, liquidity in the Canadian market, I mean, it's been pretty impressive to see borrowing costs that have actually right out, I would say in the 6 to 8 weeks following the crisis that we've seen rates drop significantly. But that didn't stop there, and I thought it would, and
Yeah.
now we're breaking records in terms of average borrowing costs that businesses face, and so part of it is the competition among financial institutions. So, despite those institutions reporting more or higher losses in some cases than expected, we still have plenty of liquidity and some pretty good deals out there.
Can I ask you a kind of a geeky monetary policy question?
Go ahead.
Okay. Today, the Bank of Canada it was Senior Deputy Governor, second in command at the Bank of Canada, Carolyn Wilkins. She said, I want to know what this actually means. Any changes to the underpinning of its monetary policy will be judged against how they affect the distribution of income and wealth in this country. Can you decipher that on the spot, JP? What are they looking for there?
There's in economics, right? One of the very first thing you learn in grad school is the first.
How to draw a
Uh,
graph.
yeah, well, that was an undergraduate. At graduate level, it's the first theorem of welfare, right? So that
Okay.
what matters then is what can you do, or what are the conditions to get to the most efficient outcome. Efficiency in this case doesn't have anything to do with distribution, right? So it's all about how do you get the most efficient outcome, and you could care less in that case, in this particular instance in terms of the distribution of income. But then there's a second theorem of welfare, which says that here are some of the trade-offs between reaching efficiency and the distribution of income, and it looks as if the bank is actually making a stance here in terms of saying, hey, we're going to be capturing the distribution of income in the economy to assess the strength of the economy, and the underpinning there is that a more uh, unequal distribution of income would lead to worse economic outcomes over the long run. There's actually quite a bit of research that supports this, right? It's not just a question of judgment and say, oh, I prefer this situation in which. It's also quite a bit of research. Top of my head, I remember the OECD research that actually showed that some higher forms of inequality in terms of the distribution of income leads to lower growth over the long run, right? So if you are about maximizing growth, you need to pay attention to distribution of income. And I think that's what's behind this.
Okay.
Although I'm not sure how do you make it work when it comes to interest rates and monetary policy. Looks to me more of a fiscal issue than anything else. But
It's a good soundbite. Like,
it does. It is. It is a good soundbite.
yeah.
I'm just not sure how you would apply it, but you got some smarter folks than I doing this
I know
monetary
how
policy.
your name did not come up. The Bank of Canada. I don't know. I was
Not, I'm waiting for the next round.
okay.
I'm
I
I'm I'm
voted
going
for
for
you,
your
but
support, Sean. Yeah.
I voted for you. Okay. So if we look at farmers and ranchers across the country, JP, from an economic standpoint, what are they cheering for here right now? What's the ideal back half, even into the first quarter of 21? What are we cheerleading for to happen?
Cheering for the crop that we have now that we're about to harvest, and if it's already started, so we're cheering for that short term. We're cheering for a strong demand overseas, right? And I'd say I've said this many times. I do think that's the one thing that we have going for us as an industry is that if you look at our export numbers, our exports in ag and food are up 14% since February. The non-ag and food in Canada exports are down 22%, right? So what we're selling is something that is in high demand in foreign markets. And I do think that, looking at China and the fact that we're ahead in terms of their recovery, where everybody thought they would be at this stage, I believe that a month ago, the forecast for growth out of China was 1% for 2020. It was one of the few economies not looking at a decline in GDP, and now they're up at 2.5%. So in
Yep.
the span of a month, they've grown more. So that's more household income, that's more spending, that's spending also on higher price products, which we sell in the Chinese market. And so all of that to me is supportive of farm income, right? So it's the demand for what we sell and market access that we have in these markets that really matter to me.
Okay. I got a question here. I'm going to relate it to a story that I read earlier this week in the Wall Street Journal. That now it was a U.S. focus, but the person that quote tweeted it was saying, he thinks the same thing's happening in Canada. As interest rates have gone down, banks are increasing their restrictions and reducing money flow, lending out to people. Viren has a question. Are banks? Do you think bank? I got to put it on the screen here. Uh, do you think banks are going to look at this COVID period on financial statements and take it into account when it comes to lending qualifications? There's probably a lot of pressure on banks, JP, to like keep money flowing here to keep businesses alive, right?
There is, and I can only speak from an FCC standpoint, right? And if you look at what we've done since the end of we got our lending capacity expanded by 5 billion based off the capital injection that we had from the federal government, just to make sure that we were able to service and meet the demands related to COVID-19. But if you look at our regular business, like not the COVID-19 lines of credits and just our regular business, we're tracking dollar for dollar compared to last year. It's amazing to see that the regular part of the business hasn't changed much for FCC. So to that sense, we haven't changed anything in terms of qualifications. Yes, we're encouraging our customers to be more prudent, run the risk management, that you need to just look at the simulations, look at the scenarios and so forth. But there's a lot of capital out there, that's for sure. And from a perspective of what I'm seeing in terms of our own lending, I can't. There's nothing that comes to mind as more restrictions or different types of approaches to lending. I think we're pretty much steady as it goes when it comes to the business here.
Well, think about proteins, right? We obviously have exports, super critical, but we also have domestic consumption of products like pork and beef and poultry. We need consumers to have the jingle in their pockets so they can buy those things when they go to the grocery store. How do they have that jingle in their pockets? One, they have jobs. Their businesses are still being able to operate. They can feed themselves. And some of those businesses require money from banks or investors to kind of keep into operation, to keep rolling. So all of this is very, very connected. It works back to the farm pretty quickly.
Absolutely, and sometimes we lose sight of the fact that because we use this argument that we're a sector that's immune to economic fluctuations, right? So we're recession proof, and when we get into a recession, ag and food is not part of the overall challenges and so forth. But we know that's not true. Even COVID-19 was special, just special in the sense of breaking down some supply chains and so forth because of the virus, as we've seen when it comes to animal proteins. But in a normal recession, which is part of the story here as well in terms of the decline in income, we know as well that consumers change their food purchasing behavior, right? So we have to think about that as well. Yes, food demand in Canada, we're pretty lucky, pretty fortunate to live in a country where we have some food security issues. I get that. But by and large, we're way better than a lot of different countries, right? On average, we spend 10 cents of our disposable, less than 10 cents of our disposable income on food. So got to be a lot to be thankful about that. But income really matters. And, when income's pressured, the safety net as well as access to capital, access to credit is paramount to navigating a recession like we have. And just like it was in 2008, I mean, one of the everybody was celebrating the banking sector in Canada in 2008, 09, right? Rightfully so. I mean, we have but it was also lots of the different steps that were taken and to get us through the crisis. And I see a whole lot of the same type of arguments going on during this crisis.
Yeah. Well, you think about it from Western Canadian perspective. There's a good crop out there, maybe a great crop. We got to get it all in the bin, right? We don't want to jinx it. The railways, because of lower amount of activity on some other commodities, they hauled all the grain. So, that pipeline is primed and ready for capacity. Like if there's that demand at a places like Japan and China is kind of back onto the demand footing that they were pre-COVID, it's lining up here to have that potential for strong exports in the back half of 2020 into Q1 of 2021, just like we felt we were going to have at the beginning of this year, and then COVID happened, right? It feels like we're right back into January here right now.
Yeah, I mean, we're set up for as lots of unknown going forward, but we're set up as an industry, if you just focus on ag and food, pretty well right now. I mean, got some challenges that we have to sort out on the process at the processing level, but from a commodity standpoint, I think we're, like you said, let's not jinx it, but we're set up okay. Let's just put it this way.
Well, let's look at it this way, JP. As we entered COVID, there was a lot of talk about how, ag's in trouble. And there was obviously some issues when it comes to things like packing plants and over about a 3 to 4 week period there. But if you compare the troubles that ag went through versus what, say, if I owned a restaurant, right? Or I owned an independent local store, dry goods store, that's a struggle, right? That's a real struggle is owning a restaurant. It's like restaurant, you're still trying to figure out how you stay open when I have to close my patio when snow starts to fly in Canada. That's like survive or die time in terms of my business. So ag we've weathered the storm for the most part.
Weathered the storm, some impacts across sectors, but I think we weathered the storm for sure. We'll see how we get out of the crisis and what it means to return to some sort of normalcy. Because what I'm hearing is there's some businesses that are quite, I mean, you were just pointing out, the struggles in the food service sector, but then it cascades down to, upstream all the way to processors and producers, right? So there's a lot of uncertainty as to how what kind of normalcy are we gonna have when we get out of this pandemic. But I think there'll be opportunities, and it's just a matter of being able to leverage those opportunities at the right time. Not easy to do, but I think the opportunities are going to be present.
If you think it's tough to own a feed yard or a grain farm right now, try owning an airline.
I wouldn't want to be that business, although I miss traveling. That's a business I wouldn't want to own.
What do you miss most about traveling? What's the thing you miss the most?
Oh, my job's fantastic, right? I get to travel and I get to talk to business owners that are just so savvy, and I learned so much by just traveling and just interacting. In most of the cases that, we got 90 some offices across the country, and I've been fortunate enough to travel in lots of different places, and interacting with producers, food processors is the best part of the job because you learn so much. And I feel like I'm at a disadvantage when I sit in an office and not travel and not interact with people and have some really good frank discussions about what's going on out there. So I've lost that intelligence, and I'm just looking forward to get it back. I mean, it's not going to happen soon, but I miss that part of the job for sure.
I'm right there with you. That's exactly the same thing what I miss about it too, is interacting with the audience, interacting with clients. You learn so much when you're out on the road and having understanding what's happening in the industry and what's driving, what are some of the variables that maybe people haven't talked about or brought up so you can write about them. And I'm right there with you. It's the same thing I miss. It's not the airplane, passion. It's not the food, it's the people.
No, absolutely. And the passion that our people in our industry have for their businesses is just second to none. And so it's contagious, right? And so you get your daily dose of energy just by interacting, with people in the business. And so that's the part that everybody misses.
I open a lot of my speeches, JP, with I feel very lucky and fortunate that I'm one of the few people that gets to travel across the country and see agriculture through so many lenses. You're another one of those people that's in that very, very fortunate club where you could be, in BC one day and be maybe in Ontario the next day, and it's the same industry, but it's a completely different view of what agriculture looks like.
Totally different, right? You go to, I remember that actually that's what you just mentioned is an actual case where I was in Nova Scotia visiting a blueberry operation, and 2 days later, I was in BC visiting another blueberry operation. And, in BC, the only thing that, business owners was interested in talking about are at the retail level, right? What's going on at the retail level, packaging. And there was just like lots of interesting discussions about what the next steps would be for that business. Whereas, You go to Atlantic Canada, and it was, relationship with buyers and selling bulk, and
Yeah.
it is just that. I mean, it's just so refreshing and energizing.
Well,
Just
we'll get back to it eventually.
absolutely.
I don't know what year it's going to be, but it's going to be eventually. Hey,
2022.
yeah. Hey, JP, this has been a lot of fun. I always enjoy our conversations about economics and what's going on in the global market. I really do appreciate you joining us here today.
Hey, it's always a pleasure to be on. Thanks so much, Shaun.
That is JP Gervais. He is chief economist with Farm Credit Canada. Hey, want to remind everybody you can tune in to RealAg Radio today at 4:30 Eastern, 2:30 Mountain on Rural Radio 147. We've got a great show for you here today. We're going to be talking to Brett Stewart with Global Agri Trends. We're going to talk about how, listen, this whole thing about pent-up demand in Asia because of ASF, it's not a done thing. It's still there. It's still real. What could we see for the back end of 2020 in terms of protein exports to China out of North America? And can China meet those commitments as it applies to the Phase 1 deal? And will Canada catch a bit of that wave of those exports as they attempt to do so? So that is 4:30 Eastern on Rural Radio 147. Thanks, everybody, for getting real and getting connected with RealAg Live. And we'll chat again tomorrow with Wendy White of Viterra. Cheers, everybody.